Welcome to This Explainer. Today, we're unpacking a literal masterclass in manufacturing growth and execution. We are looking at the FY26 financial and operational results for Sambhv Steel Tubes. Now, usually in the manufacturing sector, when a company pushes for really massive, aggressive scale, you see their profit margins take a hit. It's just the cost of growth. But what Sambhv Steel Tubes achieved this fiscal year completely flipped that script. They somehow managed to perfectly combine massive scale with actually expanding margins. It's a true growth flywheel in action. So let's dive in and break down exactly how they pulled this off. Here's our roadmap for the explainer today. We're going to cover 1. Record-breaking fiscal growth. 2. The strongest quarter ever. 3. Massive capacity expansion. 4. Captive power and efficiency. And 5. Strategic vision for growth. All right, let's jump right into section 1, record-breaking fiscal growth. Like I said, scaling up physical production often pressures a company's bottom line in the short term. But Sambhv completely defied gravity here. Let's drop the macro hammer right away. 2,413 crore rupees. That is Sambhav's total revenue for FY26. And this isn't just some incremental bump. We are talking about a staggering 60% growth year over year. When a manufacturing company grows its top line by 60% in a single year, you have to pay attention. But honestly, the really compelling story is what happened to the cash left over after all the bills were paid. Take a look at the pacing of the growth across the board here. Revenue is up 60%, right? But EBITDA, that's earnings before interest, taxes, depreciation, and amortization, grew even faster, jumping 79% to 276 crores. This basically meant their EBITDA margins stayed rock solid, remaining above 11%, despite that rapid scale-up. And the bottom line? Profit after tax, or PAT, more than doubled to 143 crore rupees. Top line grew fast? Sure, but man, that bottom line grew even faster. So what's actually driving those incredible financial figures? Physical volume. Sambhv hit a record 3.96 lakh tons in sales volume for FY26. That is a 37% jump year over year, driven by incredibly strong market demand and just highly efficient capacity utilization. They kept the machines running and the products flying out the door. And because they managed their costs so well while pushing all this volume, their PAT margin improved from 3.8% the previous year all the way up to 6%. Let's see how this full-year momentum built into their absolute peak. Moving on to Section 2, the strongest quarter ever. This peak isn't just my interpretation of the data. This is a direct statement from the company's con call filings. Q4 FY26 was officially the strongest quarter in the company's entire history. It was a period where strong demand, peak capacity, and strict operational discipline perfectly aligned. To really understand why Q4 was so historic, we gotta zoom in on one very specific micrometric: 9,500 rupees. That is the EBITDA generated per ton of steel during that specific quarter. This is just a brilliant illustration of operating leverage. See, when you push record volumes through your factories, your fixed costs get spread out over a much larger number of units. Because they executed so well, every single ton they produced in Q4 was generating around 9,500 rupees in operating profit. And because of that stellar per ton profitability, the Q4 PAT margin hit an absolutely impressive 8%. The source highlights explicitly point to improving operating leverage and execution efficiency as the main drivers here. They weren't just selling more steel, they were making significantly more profit on every single piece of steel they sold compared to previous quarters. But, you don't just hit record volumes by accident. Okay, Section 3, massive capacity expansion. Let's look at how they're building the engine. The management team is systematically taking their cash and plowing it right back into the ground to build a bigger engine. Just look at their stainless steel cold-rolled or CR coil capacity. On the left, their previous capacity was 58,000 tons per annum. Now look on the right, 116,000 tons. They quite literally doubled their capacity here. And what's fascinating is how they did it. They used what they called debottlenecking. Basically, they went in, identified the specific holdups in their existing production process, and fixed them to unlock this massive leap. It's a really smart way to directly improve scale efficiencies and get more product out into the market. And the expansion absolutely doesn't stop with coils. They're also expanding their ERW, electric resistance welded pipes and tubes capacity by 1.5 lakh tons. This pushes their total ERW capacity to an unbelievable 500,000 tons. The crucial takeaway here is that they aren't just churning out more raw steel. They're strategically strengthening their grip on downstream, value-added products like pipes and tubes. These are products that typically command much better margins and have more stable demand. But producing 500,000 tons of steel requires an enormous amount of electricity, which can be a hugely volatile cost burden.
Which brings us to Section 4, Captive Power and Efficiency. To protect those expanding margins, we really need to understand the concept of backward integration. I know, it sounds like corporate jargon, right? But it's actually simple. It's when a company takes control of its own supply chain to drastically reduce operational costs. Instead of buying power from the grid at fluctuating, usually high commercial rates, Sambhv is choosing to generate its own. Think of it as a giant cost-killing shield that protects their bottom line from outside volatility.
So how are they actually executing this backward integration in the real world? By setting up two massive captive power plants. They're building a 30-megawatt plant at Sorora and a 25-megawatt plant at Cusa. The goals here are crystal clear: drastically reduce power costs, improve overall operational efficiency, and massively enhance their self-sufficiency. This ensures that all those hard-earned profit margins aren't just eaten up by utility bills.
And it's not just about self-sufficiency either. It's about technological efficiency. Sambhv recently signed a Memorandum of Understanding under the government's PLI, or Production-Linked Incentive 2.0 scheme. This specific move is zeroed in on manufacturing thinner-gauge stainless steel CR coil. Participating in this scheme is expected to heavily support their tech and product expansion, keeping them right at the cutting edge of manufacturing. So we've seen the record growth, the margin expansion, the capacity leaps, and the cost protections.
Finally, Section 5, Strategic Vision for Growth. Let's pull the whole shebang together. When you look at the management's core focus areas, it reads exactly like the playbook we've just deconstructed. They are relentlessly focused on capacity expansion to drive volume, backward integration to lower costs, continuous margin improvement, maximizing scale efficiencies, and expanding further into the stainless steel value chain. It's a highly focused, totally unified strategy designed to yield multi-year growth. And that perfectly sets up the timeline. We started with Q4 FY26, their strongest quarter on record. Right now, in the present, they're deep into these massive capacity expansions and their PLI 2.0 tech scale-up. But look ahead to Q4 FY27. That is the target for the commercial commissioning of their QSO Greenfield project, which is going to add another 3.6 lakh tons of stainless steel capacity to their operations. The flywheel is literally only spinning faster. Which leaves us with this final thought. We're looking at a company that took a 60% revenue jump, managed to actually expand its profit margins in the process, and is currently doubling down on both factory capacity and internal power generation. With this aggressive volume-led growth perfectly paired with intense cost competitiveness, just how high is the ceiling for Sambhv Steel tubes? It's a fascinating question and one we are certainly going to be watching closely. Thank you so much for joining me for this explainer, and keep learning.